The world's strongest currency, plus 40% against the dollar since the beginning of this year. GDP growth, over 4% for 2 consecutive years. Unemployment at its lowest in decades, barely exceeding 2%. Stores full of goods, the capital city thriving. This abbreviated description of an economy, without naming the country, would be taken as a characteristic of a strong economy and effective government policy. Meanwhile, all of this is true today about the economy of the Russian Federation, a country mired in sanctions, cut off from Western markets, spending fortunes on armaments. On the other hand, at the same time, its minister says the country is on the brink of recession. The aura surrounding the Russian economy is indeed hazy. Those rooting for Ukrainian defense of independence continue to seek signs of the imminent collapse of the Kremlin's economy. Meanwhile, supporters of Vladimir Putin's regime mock the initial predictions of rapid economic collapse, showing that the Russian economy not only continues to function, but is posing results better than many Western countries. While the truth is, as usual, more complex. What is the true state of the Russian economy? Let's find out. The Russian economy is surprising everyone, posting GDP growth above 4% and reaching its lowest unemployment levels in decades. This clearly illustrates how complex and unpredictable global economic trends truly are. As a creator who regularly dives deep into geopolitics, I understand how crucial it is to have effective tools to translate such insights into action. That is exactly why I have been partnering with XTB for almost 4 years now. The XTB app is central to my personal investment strategy, allowing me to swiftly react and capitalize on global events, directly reflecting the latest trends in my portfolio. If you are following geopolitical events closely, your understanding of global dynamics is already well above average. XTB empowers you to put that knowledge to work. Invest in thousands of stocks and ETFs without commissions, up to 100,000 euros turnover each month. Check out XTB in the description below. By clicking the link, you directly support our channel. Always remember, investing involves risk. Looking at some metrics of the Russian economy, it may indeed turn out that the Russians were right. On December 31st, 2024, Russians had to pay as much as 113 rubles for $1. Now it's below 80, a level similar to the one before the invasion of Ukraine. The Kremlin's currency has thus strengthened by a significant 40% since the beginning of this year against the globe's dominant currency. In the context of GDP, Russia's situation looks even more impressive. In this table, we can see a comparison of GDP growth for selected European countries, the US and Russia, over the past 3 years, according to IMF data. In the year of invasion, Russia theoretically experienced a mild GDP contraction of less than 1.5%. At the same moment, the economy of attacked Ukraine shrunk by nearly 30%. From then on, it only got better. In 2023 and 2024, the Russian economy grew at a pace of over 4% annually, unattainable for Western European countries. The cumulative growth of the Russian economy over the past 2 years beats all EU states and America, and even including the invasion year, the economic situation of recent years looks good. Russia then appears in the middle of the pack, expanding its GDP by nearly 7%, while Germany is almost at the same level, and Ukraine is still 20% below its 2022 level. Add to this what many employees desire: low unemployment. Nearly 11% of Spaniards remain unemployed. The EU average is nearly 6%, and in Russia, merely 2.2%, the lowest level in decades. And if this material was indeed a laudation of the quality of the Russian economy, it could end at this point. However, all of this is essentially a facade, behind which hides a more complicated picture of the Kremlin's economic situation. And there is no hiding. it is tough. Therefore, at this point, a gradual deconstruction of the integrated picture of the Russian economy is necessary. Let's start with the last parameter, unemployment. Low unemployment is positive for workers, but a very negative situation for employers, especially since it's not created by a thriving domestic market whose boom the human resource base cannot keep up with. The reason is clear: war, which is the meta-cause of all the ailments we'll address shortly. Marco Rubio recently said that according to American estimates, 100,000 Russians were to die on the front in 2025 alone. Assuming that usually for every one killed, there are 3 wounded, this could give a figure of 400,000 killed and wounded in this year alone. Over the perspective of 3 full years, it is possible that we are talking about 1 million killed and wounded, potentially unable to work. A June CSIS study confirms these assumptions, writing, Russia will likely hit the 1 million casualty mark in the summer of 2025. A stunning and grisly milestone. Add to this the second reason for low unemployment: brain drain. Here it is difficult to find concrete data. Some people left Russia permanently after 2022, some returned, and some operate in hybrid mode, traveling to countries that haven't closed their borders to Russia. Here again, according to Stanford report, we are talking about a number between 500,000 and 1 million people. 2 million out of a 143 million population may seem like a small loss, but let's consider that we are talking mainly about one gender, men, and specifically men in the most productive period of life, between 20 and 50 years old. Additionally, those who left the country permanently are usually best educated fraction of society, representing typical brain drain situation. As a result, Russian companies lack as many as 2.6 million workers, representing a 17% increase year over year. At this pace, according to Le Monde, Russia will be short 10 million workers by 2030, just 5 years from now. That's a population the size of the Czech Republic. However, war and its consequences drain the country not only of people. The state treasury, too, is starting to echo with emptiness. Russia's National Wealth Fund, the country's key financial cushion built over the years from oil and gas profits, could be exhausted by 2026 if current economic trends persist, according to economists from the Russian Presidential Academy of National Economy and Public Administration and the Kojder Institute, writes the Moscow Times. The fund's liquid assets before the war amounted to $120 billion, and today, as of July 1st, 2025, have fallen to $53 billion. Just a month earlier, they were at just $35 billion, thus 30% of the pre-war level. This may be caused by a slight increase in hydrocarbon sales in June or indicate changes in counting methodology or reclassification of some long-term assets, such as bonds or shares, as liquid. Moreover, the fund consists mostly of Chinese yuan. Why is the fund shrinking? Again, there are several reasons, all tied together by war. In 2025, Russia increased military spending by 25%. As a result, as much as 40% of budget expenditures are currently allocated to armaments and the defense industry. In nominal values, at the current exchange rate, this is even an amount approaching $200 billion annually, over 7% of GDP. Furthermore, the Kremlin conceals part of military expenditures and transfers them to other budget departments. As a CPRI report states, Russia hides expenses related to paramilitary services, Rosgvardia, FSB, and social support expenditures for soldiers and their families. To show the scale of militarization, as recently as 2021, Russia spent less than 5 trillion rubles on the military. Today, it is over 15 trillion. The Kremlin allocates the maximum resources it can assign to war without bringing about state paralysis, though it is balancing increasingly close to that line. Disbalancing because the main budget revenues are still revenues from oil and gas, and these are faltering. John McCain once famously said, "Russia is a gas station masquerading as a country." Today, these words still carry much truth. Officially, the budget of the Russian Federation relies on direct sales of oil and gas for about 30 to 35%. 80% of that is oil. But that is only one side of the coin. The other half comes from taxes on companies and people connected to the oil and gas sector. About 15 to 20% comes from corporate income tax from companies like Rosneft, Gazprom, and Łukasz. Add to this value-added tax and personal income tax from individuals living off this industry. Effectively, even as much as 60% of the Russian budget rests on this single branch. A branch that's increasingly creaking. Oil price is de facto the most important criterion guiding moods in Moscow. High oil prices and sanctions loopholes allowing its export are precisely what most powerfully fuels the Kremlin's war machine. Meanwhile, Russian Urals crude maintained an average level of $52 per barrel in May and $60 in June, though it had episodes of dropping even to $47. However, the Kremlin assumed a price of $70 in this year's budget plan. This strongly impacts profits. In this table, we see a comparison of year-over-year profits of leading Russian energy companies. Rosneft minus 74%, Łukasz minus 82%, Surgutneftgaz minus 264%. The situation is similar in the gas market. Gazprom has had its worst year in history. It recorded $13 billion in net losses. Gas is more difficult to diversify due to existing pipelines leading mainly to Europe, and lack of sufficient infrastructure for LNG transport. But even here, Russians experienced a 22% decline in the first quarter of 2025. The reason? Further EU sanctions. Is it just a seasonal effect? No, because we are comparing year over year. Though it should be noted that Russians had even worse situation in the first half of 2023, when Urals oscillated around $45 to $50 per barrel, although Russians made up for it in November, when Urals approached $80. Will it only get better again now? It is hard to predict how the oil market will behave, but several facts work against the Kremlin. First, the EU and Americans are trying to patch sanctions loopholes, repeatedly targeting Russia's shadow fleet. The latest EU sanctions package hits another 105 ships. But that's not all. The latest 18th round of sanctions, according to Brussels, is to be one of the strongest so far. Besides the shadow fleet, it imposes a ban on Nord Stream pipelines, hits Chinese banks enabling sanctions circumvention, and most importantly, adds a more effective price cap on Russian oil. This was previously set at $60 per barrel. So when oil prices in global markets fell below that level, the Kremlin was not penalized in any way. Now the price cap is to be just $47.6, thus only 68% of the level assumed by the Russian budget. The cartel in which Russia is associated, OPEC Plus, also works against the Kremlin. OPEC Plus has the decisive word on global oil prices, accounting for nearly half of global supply. Meanwhile, the association had been increasing oil production for the third consecutive month, lowering commodity prices in global markets. In August, this trend will be maintained. Moreover, Russia habitually violated OPEC Plus agreements by producing more than it committed to. Therefore, it now must cut production. All this casts a shadow over the budget plan. For the first 6 months of this year, Russia's budget deficit amounts to nearly 3.7 trillion rubles, that is $47 billion. This means it is 6 times larger than in the analogous period last year. Expenditures increased by 20%, while revenues by only 3%. We are constantly talking from a very broad perspective. But when specific sectors of the Russian economy are examined closely, the scale of problems that are internally accumulating comes to the surface. Much of the credit for this goes to Yevgen Istrebin, who monitors the internal situation in Russia based on official data from Russian agencies. Here again we have a handful of numbers awaiting us. New department sales in Russia, 38% down year-over-year. New apartment construction, in June, minus 22% year-over-year. It turns out people don't have money to repay loans. The value of overdue debt from loans granted to Russian citizens reached 1.5 trillion rubles, representing a 40% year-over-year increase. This puts banks in a difficult situation. Sales of overdue debts increased by 30%. Therefore, as Bloomberg reports, heads of the largest Russian banks are already talking with the government about bailouts that may prove necessary in 2026. In other sectors, the situation is no better. Car sales are falling massively, 27% down, as well as trucks, 66% down. Similarly, for agricultural equipment by 33%, and road machinery by 41%. The steel, coal and timber industries are facing problems. Steel production is down 18%, coal production is predicted to lose $4 billion by the end of this year, and timber production is down 13%. To save the budget, experts call for immediately increasing taxation. We need to use all available resources to increase the revenue base, said Anatoly Artamonov, head of the Federation Council Committee on Budget and Financial Markets. Despite the fact that, let's recall, last year the income tax was raised from 20 to 25%. Simultaneously, the government is saving itself by issuing bonds at a record pace. Theoretically, Russia's federal debt is relatively small, at 16.5% of GDP, compared to 58% for Poland, 64% for Germany, or 130% for the USA. The catch is that servicing this debt is very expensive in Russia. The cost of debt service in relation to debt, in Russia's case, amounts to over 9%, while for Germany it is only 1%. The reason is the very high interest rates on the Russian domestic bonds. The central bank's base rate is at 20%. Why so high? Given that inflation in Russia in June officially amounted to just under 10%? Because unofficial inflation is probably much higher, though it should be noted that the central bank has begun slowly cutting interest rates. Finally, let's return to the GDP table from the beginning of this segment. How then, under such conditions, does Russia manage to maintain such a good trend? There are several reasons. First, a decent situation in the oil market over the past 2 years and circumventing sanctions. Second is the government pumping money into the economy, thereby draining domestic resources, including the national fund we discussed earlier. But this pumping is concentrated exclusively on one sector: military. In reality, this growth is hollow because it doesn't reflect improved productivity and real welfare growth. The growth doesn't translate into private investment or household consumption, as suggested by data on declining sales of apartments, cars, equipment, etc. We see this in this chart. The economy remains in stagnation, or taking into account unofficial 20% inflation, in stagflation. Only the military industry is experiencing a boom. But even this is ceasing to suffice. After 4% growth year after year, the IMF predicts only 1.5% growth this year, which, with 40% spent on armaments, really means a recession in all other sectors. In 2026, this growth is to be only 0.9%. Let's also return to the, quote, strong ruble case. This is also mainly the effect of state intervention. It is caused by strict capital controls. Russian citizens cannot freely transfer money abroad. There are limits on currency transfers. Foreign companies also cannot send profits outside Russia, effectively remaining hostages of the Kremlin. Finally, exporters are forced to convert even 80% of foreign currency income into rubles within a specified time. This is again overlaid with high interest rates and restrictive monetary policy. And here again, one could put a period and argue that things are bad and everything will collapse like a house of cards at any moment. However, this optimistic, from a Western perspective, view would simply be unjustified. Observing the state of the Russian economy, one should appreciate that despite being the world's most sanctioned country, it is able to endure in this state for over 3 years and remain the offensive side in the war. The head of the central bank, Elvira Nabiullina, deserves recognition for undertaking the impossible, or being forced to do so, and staying afloat. Despite constantly thrown obstacles, Russia endures. Add to this skillful circumvention of sanctions, constant support and economic colonialism from China, as well as self-sufficiency in many sectors. However, the greatest credit lies with the Russians themselves, who accept the cost imposed on them by the state in the name of war. The mentality of, quote, poor life but great Russia, professed by millions of Russians, allows Moscow to maintain stabilization in the country while simultaneously shifting all available domestic resources toward winning the war in Ukraine. Therefore, the most accurate characterization of the current economic situation of the Russian Federation is not imminent collapse, but structural, constantly deepening decay. Of course, no crisis happens overnight. Let's remember that the Kremlin can always count on the Chinese support, though this is also a sign of weakness and strengthening Moscow's quasi-vassal status vis-à-vis Beijing. Ernest Hemingway once wrote in The Sun Also Rises, "How did you go bankrupt? 2 ways, gradually and then suddenly." Russia is still in the first phase. Crisis is a certain sum of constantly accumulating problems, and these, as we can see, have been growing in Russia for over 3 years. So how much economic space do Russians have left? Nobody knows this, including the Russians themselves. There are so many variables with oil prices and sanctions effectiveness at the forefront that predicting the outcome is little more than fortune-telling. However, one thing is certain: this is a period with an end date.